Welcome to EVNTAlpha, where I cover economic news and data, the S&P 500, and stock trading signals with captivating historical performances. With the S&P at a crucial technical spot for its current rally, the next 2 weeks are one of the most pinnacle times in its history. With geopolitical controversy re-escalating in one of the most important weeks for monetary policy, are stocks ready to keep going, or are we in for another grueling pullback? Remember how I said on Thursday it seems the Iran conflict is seemingly flip-flopping every day? Well, unfortunately it seems the Iran conflict has re-escalated after the S&P has rallied off of news that a new peace deal could be made. With geopolitical tensions rising yet again, this will likely be bad for markets as risk is now officially off and many will be looking to exit positions on Monday. So watch out for a volatile open as it could get messy. To make things even worse, check out this tweet by Winkle, which highlights how historically markets have been deep in the red on this coming Monday. With the geopolitical news causing hysteria amongst investors, we certainly could see a dip tomorrow. What do you guys think? Do we see a heavy drop, or will this all end up being false hysteria that leads into further bullish momentum? All I know is this is certainly a time to continue to remain cautious, as the political and monetary environment can change rapidly in the coming weeks. Now remember, we have CPI coming out on Tuesday as well amidst this bearish news, which could also be a severe bearish catalyst. Should we see inflation reaccelerating, it could pose even more problems for the S&P, as that will likely add fuel to this bearish fire brewing. Shortly after, we have Kevin Warsh's testimony, in which we will get a better picture as to how the Fed is digesting the new inflation numbers. If we hear hawkish language, we can certainly see markets take a hit even further, so definitely be paying attention to that meeting. The very next day, we have PPI coming out on 8:30 a.m. Now, while CPI will show you how consumer prices are reflecting inflation, PPI will show you how producers' prices are reflecting inflation, right? So if the manufacturers themselves are experiencing inflation, you will also see PPI tick up. Now, along with CPI, we definitely want to see this come down as well and start to decelerate. Lastly, on Thursday, we will have retail sales coming out at 8:30 a.m. Now, this is a great reflection of consumer confidence, right? If you're seeing retail sales increase, that means consumers or feel comfortable with the economy and how it's going. Vice versa, if it's lower, right, that means consumer confidence is lowering. Hence, the economy is likely taking a bit of a hit. We also will have initial and continuing jobless claims coming out. As I've noted before, this is a fairly high-frequency report the Fed likes to watch out for preemptively for the monthly payroll reports that come out. So if you would like to see a dovish shift in the Fed, right, we want to see the labor market start to weaken so that there is a valid excuse to cut rates. So let's jump a little bit into some S&P price action. So over the past couple days, we've been talking about this bullish breakout of a triangle experienced on July 2nd of this month. And we are still valid, or this break is still valid, as we never broke back below this trend line, as we talked about how we had a major rejection wick when we went on to retest the trend line. And this was likely bullish to go on to see further prices upwards. And so as you can see, we did end up breaking through the 78.6 and we went along to test our 75.78. Now with breaks outside of a triangle, it implies you go on to test the pivot highs along the way, right? So if we start breaking through 75.78, this brings in the possibility of seeing a retest of all-time highs as well as potentially new all-time highs. Now, also, if we break through 75.78, this validates our ABCD pattern that we've been talking about, in which it calls for a 1.236 to 1.618 retracement of our B to C move. So should we break through that 75.78 swing or pivot high at B, right, this implies we have validated our pattern and we are likely to go on to see these upward targets. Now, come Monday and Tuesday, should we see some bearish news and the S&P begins to reverse, we're going to really want to pay attention to this yellow zone again, right? We want to see, does it bounce off this yellow zone or does it start trading through? And if it starts trading through, does it trade below and close below the yellow zone, right? If we do see it close below the yellow zone, that likely implies we go on to see the 7300s again, similar to back on June 15th and 16th when we had our Fed meeting that shifted hawkish very rapidly. Now, the first stock I want to talk about is ticker ROL, and what you're viewing on the screen here is a strategy called Stochastic RSI 14-week. So in the first panel, you're seeing ROL's price over the past 7 years. In the second panel, you're seeing RSI on a weekly frequency. And then on the third panel, you're seeing stochastic RSI, which is a measurement of RSI, essentially to identify when RSI is picking up momentum itself. Now, this strategy will trigger whenever RSI is under a certain threshold, and then stochastic RSI builds momentum under 20, right? And so you'll see that with the green dots on the price action in the first panel. Now we've seen 5 triggers in the past 7 years in which the price rose on average 18% over the next 113 trading days, or just roughly about 5 months and 3 weeks. Of the 5 signals historically, the price was higher 100% of the time when leading into that 113th trading day. Now we saw a 6th trigger on April 10th, and recently a 7th trigger this past Friday on 7/10. So it'll be interesting to see how ROL performs over the next 6 months. Now, taking a look at the reactions here, on the x-axis we have trading days out from the trigger, and on the y-axis we have cumulative percent change. So in other words, what you're viewing here is what your returns would be on ROL should you have bought on every single one of those buy signals and then held for 120 trading days. Now in blue, you can see the average lead up to the 18.5, and in yellow we have our active triggers, one being April 10th of this year and the other being this past Friday. Now for the trigger on April 10th, this is a really good lesson that just because history has shown strong performance does not guarantee this time around you will see strong performance, right? So stop losses are incredibly important, and risk mitigation is incredibly important. We saw our trigger in April 10th begin to trade outside of the typical range we saw historically, hinting that maybe we're in for a very different reaction this time around. Now, given ROL has taken quite a beating and has had quite the drawdown, I'm fairly optimistic on the second trigger that just occurred this past Friday. We'll just have to keep an eye out and see how it begins to perform over the next couple days. So I went ahead and plotted what that roughly 18.4% on average would look like over the next 113 trading days. So that brings you to about $52.64 a share leading into December 18th. I also put a stop loss about 6% to respect a 3-to-1 ratio. I also mapped out some major support and resistance zones to keep an eye out for as we're currently trading in between them. And something I really want to point your attention to is this major head and shoulders pattern that just played out. So last video we also talked about a head and shoulders pattern. Generally speaking, it calls for, a shoulder, a head, and another shoulder, and then you have your neckline, right? And so whenever you break below the neckline after building those shoulders and head, right, it calls for a drop similar to the peak of your head to the neckline, right? So I went ahead and copied this trend line that's dashed here and placed it on the break, right? So that put our target down to about 41.74, and as you can see, it actually did reach that price target, finishing out our head and shoulders pattern, and now it seems to be attempting to bounce outside of these zones as support. Now, should we start seeing it trade back above this yellow dash line, as notice this is a major resistance at this point from back in January of 2025, this is a really good sign that we may go on to retest the trend line of this neckline, right? And so if you start seeing a trade back above that yellow dash line, really we're going to look out to see if we do get that 18.4%. If not, maybe we get up to this trend line of the neckline. The second stock I want to talk about today is ticker ADSK, in which it also had a stochastic RSI signal this past Friday, July 10th, in which the price rose on average 16.8% over the following 110 trading days, or just about 5 months and 2 weeks. Now, of the 6 historical triggers, we've seen the full 120-day reaction window. All those 6 times the price was higher on that 110th day. We've had our 7th trigger on February 27th and the 8th trigger this past Friday, July 10th. Taking a closer look at ADSK's reactions, we can see in blue that average return lead up to that roughly 16.8%. Also, if you look, notice that we have our trigger that occurred on February 27th that is currently playing out, leading into the 100th trading day. Notice it had a little bit of a jump in the first 20 days, but then ultimately went on to perform very in line with the average. Ultimately, we ended up down closer to our min return, nearing about the 90th trading day. Now, something I really want to point out here is notice that the average return is actually in the negative the first 2 months, and then does it start to pick up, right? So this is essentially telling you we may have about 2 months of consolidation below before you ultimately actually see any pop if it does happen. This is also another great example to show that just because history shows that it is the more likely outcome, that does not guarantee that this time around the price will be higher. Last thing I want to point your attention to is notice that a lot of the reactions that were around this negative 20% performance started to pick up those last 2 months. And so maybe we see that this time around, given we had a second stochastic RSI trigger to pair with the one in February, on February 27th. So I went ahead and plotted what that roughly 16.8% on average would look like, bringing it to about $243.74 a share, leading into December 16th of this year. Now, I went ahead and also marked with the green vertical line that 2-month mark, right, in which we tend to see, based off historical returns, the average comes down those first 2 months and then begins to pick up, right? So just to harp on the point, we did have 2 months of consolidation in the red before it did actually go on to perform well. I also went ahead and plotted some major support and resistance zones to pay attention to. We're currently trading in between 2 major ones, with the resistance being around 320 to 350 and our support being around 186 to 196. The fact that we bounced off this support zone is generally a good sign that we may go on to test the upper resistance here around 235. Now notice we had a triangle break to the downside that occurred on January 2nd of this year, right? This generally implies you go on to test the pivot lows along the way, right? So we went ahead and did test those lows, as you can see. And now that we finished out our 2 targets of those swing lows, right, maybe we continue to see a base build before we finally get that potential 16.8% return on average. If not, maybe we get to this trend line at least, for example. The third stock I want to talk about today is ticker FLEX, in which we saw a stochastic RSI signal as well this past Friday, July 10th, but on the daily frequency, so it's calculated on a 14-day time frame instead of a 14-week time frame. Generally on a daily frequency, you're going to get much more frequent triggers than, say, your weekly stochastic RSI signals. Now, FLEX jumped 40% on average over the next 119 trading days, in which whenever we got the buy signal from stochastic RSI 14-day, roughly about 94% of the time of those historical 16 triggers was the price higher come that 119 trading day, or just about 6 months. So taking a close look at Flex's reactions to those stochastic RSI 14-day triggers, we can see on the x-axis trading days out from the trigger, and on the y-axis cumulative percent change. So essentially you're seeing what your returns would be over time if you had bought Flex on each one of those stochastic RSI signals. Now in the blue, we can see that average lead up to the just about 40% on the 119th trading day. And generally this is a really strong event study. You're seeing much more upside potential relative to downside potential. As noticed, majority of the reactions struggled to drop much lower than our trigger price, just about 10 to 15%, versus the 40% upside potential we're seeing in some of these reactions. So this is what that 40% on average would look like should we achieve it this time around. That would bring it to about $190 a share leading into the new year. On the downside, I'd put about a 13% stop loss to respect a 3-to-1 ratio. However, again, you can always structure your stop loss however you like. That's palatable to your risk structure and investment style. Ultimately, in the position Flex is currently, you definitely want to be cautious and preemptively entering longs here, given we have a humongous gap that occurred on May 6th of this year. Now, generally with gaps, right, at some point, it's assumed you're going to go on to fill it later on, right? So chances are at some point we do see a retest of this $96.50 a share. When that will be, unfortunately, gaps don't give you a crystal ball to know that. However, just bear in mind, if we do start seeing prices trade back below this trend line in pink, along with the end of our gap at around $119 a share, chances are we do go on to fill this gap and see prices back down around here. Now, should we continue to bounce, right, you're going to see us break through this resistance at around 146. So if we start closing above it, that's a good sign. We're going to go on to test the resistance zone between 158 and 167. Now, should we break through this, that definitely puts into play potentially seeing that 40% average return leading into the end of December. So the last stock I want to talk about today is JBL, in which it also experienced a stochastic RSI 14-day trigger this past Friday, July 10th. We saw JBL rise 34% on average over the following 117 trading days, or just about 6 months, across the 15 historical triggers. About 93% of the time of those 15 triggers, the price was higher when looking at the 117 trading day out. Taking a look at JBL's reactions, we can see in blue that average return lead up to about that 34% at day 117 out from the trigger, or again, just about 6 months. This is also fairly strong event study in my books, in which you're seeing much stronger upside potential relative to downside potential. Now, in some of the reactions that did not go well, we did see drawdowns upwards of 20%. So again, you're definitely going to want to set some stop losses just to protect your downside risk, and set it at a loss that you're comfortable with and that fits your investment style. So if JBL were to achieve that 34% on average over the next 6 months, that would bring it to about $443 a share leading into December 24th of this year. Put a downside risk of about 11% to respect the 3-to-1 ratio. However, again, this is not concrete. You can set the stop loss however you want should you, for example, want to play this situation. Now, some few major things I want to point out here. One, we have a major support zone down at 228 to 246 that has gone fairly untested since we broke through it and continued to see upside. So generally speaking, right, it's not guaranteed we come back down to the support zone. However, if you do start seeing JBL take a bit of a spill, right, this is one of the biggest support zones to be paying attention to. Now, in terms of closer context to where we currently stand, we are building what's called a megaphone structure, which generally tells you that volatility is rapidly increasing and there's increasing indecisiveness between buyers and sellers. Really, nobody's in control at this moment. It's just kind of battling in this megaphone structure. We also have some major support at our 100-day moving average, along with our support zone around 322 to 313 a share. Now, if you're a bull, you want to continue to see us bounce off this trend line and go on to test the top of our megaphone structure. And generally speaking, right, if we do continue to bounce and say break the high here at 342.84, that could be a really good sign that we're going on to switch back to bullish. Now on the downside, if we start trading below our 100-day moving average and break below the support zone, that makes it fairly likely we go on to see a retest of the support at 282. And so you're going to really want to pay attention over the next couple of days how we react to the support zone, as well as this swing high here at 342. So that's everything for today. If you enjoyed the video, please give it a like and subscribe, and I hope to see you in the next video.